As the COVID-19 pandemic took its toll on the world in 2020, we have seen a rising of initiatives from governments to save and bail out of bankruptcy various failing companies, mostly in the hospitality and tourism sectors like hotels and airlines. But many key figures on Wall Street call out the bailout shouldn't be used on companies that wasted their earnings on stock buybacks to inflate their value and not prepare for a bad economic environment. Here is, for example, how Social Capital CEO Shamat Palihapitiya reacted to it.
When you do things like buybacks and dividends, what you are essentially saying is you are throwing your hands up in the air and declaring to the world, I do not know what to do with this money. And instead of deciding to save that money, to try to do M&A, to try to invest in R&D, to pay your employees more, these people have given it back in an open market purchase. Now, let's look at that for a second. Why is that a stupid idea? Well, it's a stupid idea for two reasons. The first is that it disproportionately only benefits the executives and the CEO and the board, because those are the ones that disproportionately get most of the stock inside of a company. And it disproportionately benefits those specific hedge funds that were agitating for that behavior and activity, who take a short-term position and allow themselves to participate in short-term profits. And now what happens is the people that believe least in the company, i.e. the people that sell the stock, get rewarded. And then who's left holding the bag? The people that believe in the business.
Here is also the Dallas Mavericks owner, Mark Cuban, on the situation.
No buybacks. Not now, not a year from now, not 20 years from now, not ever.
Actually, even the president spoke about the issue.
Some companies, as you know, did stock buybacks, and I was never happy with that. It's very hard to tell them not to, but I would tell them not to. I would say I don't like it for that reason.
In a time where unemployment has reached unprecedented peaks, why are so many key figures raising their voices to not bail companies that do stock buybacks at most, or limit and regulate stock buybacks at the very least? Let's find out all about it. When companies have cash on hand, they can do one of three things: reinvest by developing new products and services, hiring new people, increasing wages, or building new factories; pay dividends, which is a way to reward investors and allow them to put money back in the economy or reinvest in new ventures; or they can do stock buybacks. Stock buybacks refer to the purchasing of stock by the company that issued them. They happen when the top executives think the company's stock price is undervalued. By doing buybacks, the company reduces the total number of shares outstanding, driving the stock price up, and if profitability remains the same, buybacks also drive up the earnings per share, which is an important metric to investors and Wall Street analysts. But problems arise when buybacks get the majority of the company's available cash, putting not only the growth of the company at risk, but also its solvency. But when did it all start, and how did we get here? Few corporations bought or sold their own shares prior to the market meltdown of 1929. But once the boom collapsed, a growing number of companies tried to prop up their own share prices by snapping them up on the open market. The practice irritated investors, brokers, and even the financial press. Back then, the objections to stock buybacks sounded remarkably like the ones of today. And in 1932, the New York Times made its case against buybacks, reporting on the many abuses alleged during buybacks. Abuses like weakening the cash position of a company and endangering its credit standing and future growth, diverting the attention of officers of a company from business problems to the speculative gyration of the stock market, the use of corporations' funds to buy shares owned by directors, officers, and other persons friendly to the management. 2 years later, in 1934, Congress made buybacks stop after it passed the Securities and Exchange Act. It cracked down on stock manipulation and insider trading, and the overall language of the law was so broad and vague that stock buybacks could be construed as a form of market manipulation. As a consequence, repurchases went into a steep decline. Then came this guy.
The future doesn't belong to the faint-hearted. It belongs to the brave.
And a great wave of deregulation followed. On November 17, 1982, the agency issued Rule 10b-18, which provides issuers with a safe harbor from liability for manipulation when they repurchase their common stock. This effectively shielded them from prosecution under the original 1934 legislation. But unlike similar regulatory safe harbors instituted at the time, the new rule had no mandatory disclosure requirements, relying instead on voluntary compliance. That meant there was no way for the SEC to determine whether a company has put all its cards on the table when it stopped buying up shares. And no way for ordinary investors to know that either. The only people who might know are corporate insiders and executives whose continued tenure is increasingly dependent on the stock price performance. Since then and until today, stock buybacks are defended by executives for the following reasons. The company shares are undervalued. The share price is not representative of what the top executives think it should be. Buybacks offset dilution per share as volume of buybacks outstrip option granted. Which, from my opinion, makes me wonder, what's the point of granting options at the first place then? Buybacks offer a great way to return unneeded cash to shareholders, which honestly begs the question, isn't the job of the CEO to look for investment opportunities to keep the company growing? I personally think these reasons are not the real ones, as the real reasons are simply manipulate stock price for the short term to please investors, increase the pay for the top executives. Especially that stock-based instruments make up the majority of the top executives' pay. Quote, in 2012, the 500 highest paid executive of US public companies received on average $30.3 million each. 42% of their compensation came from stock options and 41% from stock awards. End quote. As a result, the very people we rely on to make investments in the productive capabilities that would increase our global shared prosperity are instead devoting most of their company's profits to uses that will increase their own prosperity. Making matters worse, the proportion of buybacks funded by corporate bonds reached as high as 30% in both 2016 and 2017, according to JP Morgan. It can make sense for a company to leverage retained earnings with debt to finance investment in productive capabilities that may eventually yield product revenues and corporate profits. But taking on debt to finance buyback, however, is bad management, given that no revenue-generating investments are made that can allow the company to pay off the debt. Finally, it's not like the buybacks are timed correctly. Companies usually make the worst investing mistakes by buying high and selling low. Over the past 2 decades, major US companies have tended to do buybacks in bull markets and cut back on them, often sharply in bear markets. GE, for example, spent $3.2 billion on buybacks in the first 3 quarters of 2008, paying an average price of $31.84 per share. Then, in the last quarter, as the financial crisis brought about losses at GE Capital, the company did a $12 billion stock issue at an average share price of $22.25 in a failed attempt to protect its AAA credit rating. To bring the subject to closure, buybacks have widespread harms and only benefits to restrained groups of people. As a consequence of buybacks, corporate profitability is not translating into widespread economic prosperity. And due to them, companies deprive themselves of the liquidity that might help them cope when sales and profits decline in an economic downturn. If Congress and regulators do not take action to control buybacks, the rampant economic inequality that already afflicts the United States will only get worse. Thankfully, Congress is taking notice. The Reward Work Act introduced by Senator Tammy Baldwin in March will ban stock buybacks done as open market repurchases. Either through this bill or another one, buybacks do need to be regulated for a better future. In the meantime, buybacks will remain as the social capital CEO Shamat put it.
Buybacks are the primary example of a growing strain of incompetence amongst CEOs and amongst boards. And it's where we need to start thinking about how the rules need to change so that average shareholders, retail investors, the stakeholders of these companies benefit more.
And that's it for today, guys. Feel free to let us know about any other topic or company you would like us to discuss next. Finally, if you are still around, please subscribe and hit the like button to support us. Till I see you next time, peace.